Hi, welcome back to another edition of Lippers Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting estimated net flows for the conventional fund business for the week ended Wednesday, March 3rd, 2020. Now, I told you we were due about the conventional fund business. We'll certainly talk about ETFs as well. For the third week in four, the conventional fund business actually saw pretty good inflows this week to the tune of $15.5 billion, but the headline numbers are really misleading, and we're going to take a deeper look in that. However, during the fund flows week, we saw that markets witnessed a huge volatility period as trepidations over the coronavirus's impact on global trade basically was partially offset by central bank intervention. We all know that the central bank, the Fed, cut interest rates by about 50 basis points and actually sent the markets into a tizzy. So we've seen 4 and 5% up and down days, and it certainly has been a lot of volatility that we've been paying attention to. The Dow and S&P 500 witnesses 3 of its 5 trading days with market moves that were 4% or greater. And again, the Fed cut the interest rates, and this really put people into a different mindset, because I think everybody wanted an interest rate cut, but then when it happened, they said, wow, what does the Fed know that we don't know? This is really bad, emergency rate cut. So we had some big moves, and this is what I said. So it was a big inflow, but it was all due to different macro groups, one in particular, money market funds. Let's go ahead and take a look at our macro groups. Equity funds saw outflows about $11.3 billion, even though the S&P and the Dow actually finished up in plus side performance for their fund flows week, again, Wednesday to Wednesday time period. Taxable bond funds lost about $11.6 billion. Those are huge numbers. Muni bond funds lost for the first week in quite a long time, $93 million though. So it wasn't a big deal. It's been like 60 weeks or 61 weeks, and we've seen one outflow, and that was this week. And then, of course, money market funds took in about $38.5 billion. Quite a story to write about. Let's go ahead and take a focused look now at the equity fund arena. In the equity group, we basically saw that for the week they had an upside performance, 0.08%, so really not a lot to write home about, but I told you S&P 500 and the Dow were up in positive territory. It's fourth week in 5, they had plus side performance. The 10th consecutive week, though, we've seen outflows, this time to the tune of $11.3 billion. Domestic equity funds handed back about $8.1 billion, 10th consecutive week they've seen outflows, but they had a plus side return, 0.13%, also for the fourth week in 5. Now, non-domestic equity funds lost money for the first week in 3, $3.2 billion this time, and they had a negative return of 0.03%. Third consecutive week they've seen outflows. If we take a look, though, at kind of a detailed look, we see large cap funds still the pariah, $3.1 billion. Small cap funds lost $1.9 billion. International equity side, $2.6 billion outflow. And on the global equity side, we saw about $654 million leave the arena as well. So now let's go ahead and take a look at what happened into the ETF side of the ledger and get the view of that. So equity ETFs for the second consecutive week actually saw outflows, this time to the tune of about $9 billion. Basically what we saw was the Utility Select Selector Spider Fund ETF, XLU, taking about $1.3 billion. The iShares Russell 2000 ETF, IWM, took in about $1.1 billion. But kind of the big behemoths, the ones that we generally keep an eye on, as far as telling you what things are going. The Spider S&P 500 ETF, SPY, lost about $3.8 billion. The Financial Selector Spider ETF, XLF, lost about $1.4 billion. And there was a lot of other smaller funds that lost money as well. Let's go ahead now and move on to our fixed income side of the arena and see what happened in there. For fixed income funds, for the eighth week and 9th, we've seen outflows. So $11.6 billion. Now, for the fourth week in 5, they've actually had plus side performance. Remember I told you the Fed cut rates? That actually is generally a boon for bond funds. They were up 0.68% for the week. Now, who took in money was the safe haven plays. Government treasury funds had about $342 million of net inflows. Corporate high quality funds took in about $223 million. Now, I'm not saying billions, I'm saying millions. But we saw the big behemoths, corporate investment grade debt funds, lose about $4.5 billion. We saw corporate high yield funds lose about $3.2 billion. And that's really really how the story continued. Let's go ahead now and take a look at the ETF side of the arena and see what happened there. Fixed income ETFs actually had plus side flows, $2.7 billion, fourth week in 5. It's fourth consecutive week that they've seen plus side performance. The average return was 0.84%. Again, those cuts really helped quite a bit. But where we saw most of the money go this time was into treasuries. So at the top of the list, we saw iShares 7 to 10 year treasury bond ETF, that's IEF, took in about $1.6 billion. We saw the Spider Bloomberg Barclays 1 to 3 month treasury bill ETF, taking about $1.1 billion. And at the bottom of the group, we see that the iShares iBox Dollar Investment Grade Corporate Debt Fund, this is LQD, lose about $2 billion. We saw the Spider Bloomberg Barclays High Yield ETF, Junk, lose about JNK, lose about $1.5 billion. So that's kind of where it was. People were into putting money back to work in this group in ETFs, but really they paid attention and went to the safe haven plays. Treasuries were the recipient of most of the net inflows that we saw. So let's go ahead and take a look at our Muni bond fund arena now as well and move on to that group. Muni bond funds basically for the first week in 61, I said it earlier, handed back $93 million. But it's the 10th consecutive week. They've had plus side returns, 0.21%. So a little bit of a head scratcher. How it broke out, though, we saw short muni debt funds took in about $130 million. High yield muni debt fund lost about $89 million. And then we saw general insured muni debt funds lose about $96 million. And there was a whole bunch of small single states that actually handed back money as well. That brought us into negative territory again, only $93 million. But again, breaking that 60-week inflow trend. Also, we saw that municipal bond ETFs basically handed back money to $157 million. This was the first week in 21 that they've seen outflows as well. So that brings us now to our last group, and that's money market funds. Money market funds for the third week in 4 took in money, huge amount of money, $38.5 billion. Certainly a trend we saw in 2019. No matter where the markets were going, it seemed that they were attracting money. It was over over a $500 billion that went into the money market funds in 2019, and we're seeing that trend again this year as people are putting on the brakes, really finding no place to hide, getting out of getting out of muni bond funds, getting out of taxable bond funds in general, and then hiding and stashing it away in the money market arena. We saw the taxable money market funds took in about $39.3 billion. How that broke out, institutional money market funds took in $20.6 billion, while retail money market funds took in $18.7, but then tax-exempt money market funds basically saw $848 million in outflows. Well, that really kind of brings us to the end of our conversation today. But we did see that February non-farm payrolls came in way above expectations, $273 million versus 165 expected. And then we saw the unemployment rate drop from 3.6 last month to 3.5 this month. But more cases of the coronavirus basically came out, COVID-19, whatever you want to call it. So I think investors are in for a very rocky road until we can see a decline in the new cases coming, particularly in the United States now. And if we can see that there's some way of decreasing the spread and that it's not going to be as contagious as people think, I really think we're going to see a lot of ups and downs. Obviously, the Fed, central banks, Canada also cut their rate. The Canadian central bank cut their rate by about 50 basis points. And we've heard many other central banks saying that they're willing to stand behind their economies and plow money back into the economy, loosen up some of the reserve requirements and the like. So we will see, I think, a lot of big ups and downs. I don't know if we're going to see 4 and 5% like we saw this week, but certainly it's something that investors are going to keep an eye on. Well, if I haven't done a deep enough dive for you, you can go to www.libertyusfundflows.com and do a deeper dive, or you can just come back and watch us next week where one of our analysts will tell you about the trends of the week. Thanks for watching. My name is Tom Roseen, and I'm wishing you the best in your wealth planning and creation.